Hello, everybody. Welcome to week 51 of 2025. We're really rounding out the end of the year here. It's coming up really fast. But as always, you've got Matt Dines and myself, Cameron Otsuka, here to go through the Build Weekly Roundup. We've got three topics today. The first two are really interconnected in a lot of ways, but I'm really excited to have Matt kind of go through. We've titled it "The World of Bonds," but he'll go through kind of a survey of where things are headed for across several different countries' bonds, and then the heavy focus will be on the BOJ, specifically for a variety of reasons I'll let Matt get into. And then to round out this week's episode, Trump Fusion. There's been an announcement of a merger between Trump Media Group as well as a fusion company called TAE Technologies. TAE Technologies. A lot there to unpack. If you thought, as you head into the end of the year, we'd have less headlines and be a little more quiet, you get to kind of rest a bit with your family. It turns out that is not the case. We're still getting headlines hot and fast every single day. So let's go ahead and kick into it here. Matt, I want to pull up this presentation really quick. You've got this outline of several different world bonds.
Yep.
Walk us through why
All
you
right.
highlight green versus red and why these ones.
Yep. So to close out the year, I don't know, Cameron, we can call this our 2025 year in review summary, but I think that's fine.
Yeah.
So we just start with a survey of what's going on in sovereign debt markets, right? I want to just kind of expand the attention or focus of kind of, if you follow X, follow discussion, ever since 2022, it's really hit kind of the mainstream awareness that there's a debt problem in the United States, but I want to or a fiscal problem as well. The other side of that. I want to look at zoom out more broadly across all of the other developed market sovereign debt that's out there to really give a sense of what in the world is happening. I know it doesn't feel like it to most people, just given the volatility that's come with this new administration, the extremely disruptive policies to hit the tariff front and international relations. You could talk about the conflict Russia-Ukraine, which has been ongoing since 2022, but didn't really get settled this year, and looks like it may just escalate further from here, just given the events we talked about last week. But the trend in U.S. dollar denominated rates has been down, right? Despite the volatility, right? It's been lower lows and lower highs on the chart of U.S. dollar denominated sovereign debt. That goes for the U.S., so everybody I've highlighted in green, but also the adjacent Latin American countries. So you see on this dashboard, Brazil, Argentina, and Mexico, their dollar denominated rates on their sovereign debt are also trending down and below their average over the prior year look back window. If everybody recalls, roughly a year ago, we were 6 weeks removed from the November elections. Everything was starting to settle in, and we were basically right at that halfway point between election day and the new administration, new Congress, et cetera, being implemented and sworn in. So direction on U.S. debt has been down. It's really clear in the chart. 1 year change, U.S. 10-year yield down 39 bips. Brazil, U.S. dollar 10-year down 85 bips. Argentina down 135 bips. Mexico, U.S. dollar denominated 10-year down 73 bips. So direction has been down, right? Some of that is inflation expectations continuing to come in. Some of it is nominal growth in the U.S. dollar continuing to come in. A lot of it is just policy, right? The tariffs effect, the monetary tightening, SOFR, replacing LIBOR, all of that we talked about is really causing kind of a migration of dollars from the offshore markets. I'd say predominantly Europe, but it also shows up in Asia as well. Those offshore dollars are coming into the Western Hemisphere, primarily to the to the home team's domestic market in the United States through New York is where you expect most of that to happen. So dollar rates down, that's in green. The only other green I'd highlight here is Switzerland. This is money going to ground, in my opinion. Swiss dollar denominated, or sorry, Swiss franc denominated 10-year debt is up roughly 5 bips on that year. Still extremely low, right? Their 10-year yield is 24 bips. So Swiss government debt is really the last sovereign that's clinging from a 10-year standpoint to these ultra low ZERP, NERP type of rates. That's the last vestige. Switzerland's financial system, its GDP, it's really too small to matter in the big picture context, so I won't focus so much there. What I want to focus on now is the ones in red, and these are the sovereign debt markets where yields are trending up. So you're seeing a divergence here. U.S. dollar denominated is coming down. Euro-denominated debt in particular trending up. So you start with, I've talked about this over the last few weeks. If you want to watch a sovereign debt market, I'd say the place to focus your attention now is in Northern Europe. So France and Germany, both of their debt is trading at 52-week high-end yields. Since last December, French 10 years, the OATs, if you will, they're up 51 bips. German Bunds up 60 bips. Everybody's well familiar with, at this point, the primary risk-free asset in the euro-denominated banking system and the euro-denominated world, period, is the German Bund. So that yield rising is telling you something. I'll focus more on France because that's really, I think, the straw that's stirring the drink here. Then you get into the next boxed in red sovereign offering, Sweden. Yield still 2.16%, up 68%, or sorry, up 68 bips over a 12-month look back window. Why does Sweden matter? Well, it's your crossing currency. If you want to move from a non, let's say like Eastern European currency, you've got a lot of countries who still haven't adopted the euro. There's several of them. To get into those economies, both to and from, and for those currencies, those financial systems, to interact with global capital markets, they'll use the Swedish krona and its sovereign debt markets as the base layer collateral to move in and out of those currencies. So it's a crossing currency from kind of the European periphery countries outside of like the EU core, Western Europe developed markets to cross and interact with, let's say, the dollar, the yen, et cetera, as global capital is moving. It's also showing in terms of its range on the 52-week look back. It's also at a similar level as what you're seeing in France, Germany, and then our last case I want to identify here is Japan. So Japan, while kind of being known as the poster child post its own bubble collapse, widely noted in the early 1990s. It's been at the forefront of central banking. I guess we can call it innovation or very experimental monetary policies that we lived under, right, if you will, from the 90s all the way up to, I would say, 2021, 2022, where I'd say under this Jerome Powell second term as Fed chair really guided the U.S. Out of that ZERP, QE dominated policy, or looks to have in the rearview mirror. We don't know what's in front of us. We can only speculate and try to prepare accordingly. But Japan, as kind of the progenitor of these monetary experimentations that we've been under for the last 30, 40 years, is now following through and looks more like it's copying in the wake of what Jerome Powell under that second term as Fed chair has really paved the way for in getting out of that ZERP bottleneck boundary condition. So I'll get into that as we go into sovereign debt markets and look at the charts in particular. But what I want to get across is it looks like as we turn the corner into 2026, this isn't Cameron and I's prediction episode, but it looks like there's something that wants to happen in sovereign debt markets. Now, in the X discussion, the FinTwit, et cetera, we overly focus on the United States, its treasury, its fiscal deficits. You'll find no shortage of doom posting, blackpilling, et cetera, about the Fed. I mean, it's easy if you want to do it. Like that's a good way to, crank up your follower count. Just um, post something negative about the Fed, monetary policy, et cetera. The problem. What we don't focus on is, in my opinion, is the global context. What's going on in Europe? What's going on in Japan? Um, there's a lot of doomerism, and while the common approach is, or the most common opinion you'll hear is everybody's, completely in the barrel. These are problems we're never going to get out of. I don't think we appreciate the interactions on a relative basis between all these strategic players, addressing each other in the greatest game, if you will, of geopolitics, financial markets, et cetera, and how that interaction is going to shape the future that we live in. So I want to look at the chart first, the U.S. 10-year. I've said this on our board meeting this morning, stuff like that, for our publicly traded funds. So I've talked through this throughout the day. But I think most people at this point, if you ask them, man on the street, what's going on with U.S. Sovereign debt, they'd say, oh, rates are blowing out. It's a hopeless situation, et cetera, et cetera, et cetera. Not realizing that the core trend since this new administration took office has been down in yields. So this is a chart going back 3 years. I drew in these would be support lines in terms of yield, where we've tapped on two occasions. One was September, October 2023. If you recall, the big event when that was blowing out was like the UK pensions, the LDI, et cetera, crisis, BOE kind of extended the QE window another 60 days or whatnot to allow that to clean up. But basically, the UK pension system running into that bottleneck was the kind of the headline event that corresponds to that top tick on the chart. We got another one right as Trump was taking office, the sell-off in yields, that handover from the Biden administration to Trump. We saw the 10-year again set the what would look like now the new resistance line or support line, sorry, on yields as they blow out and find a bid. So you zoom out, you look at this chart, you look where we are over the medium-term trend in this new secular bear market in bonds that we really entered in 2022, right? When the Band-Aid got ripped off, one of the worst 2 to 3 bond years in bonds in the existence of the United States, which is about to hit its 250-year anniversary. I want to call something out, the red circle I've highlighted. Look at that empty space in between that support. So talk about this pressure in sovereign bond markets, right? You have yields rising. We're going to get to that in a second. But what this is showing is there is a bid behind U.S. Treasury debt. Now, where is it coming from? Could be a lot of places. I mean, we talked about roughly 2 to 3 weeks ago the changes that the Fed made in its rulemaking in terms of the enhanced SLR ratios, like moving down that extra capital cushion, if you will, that the Fed would require its G-SIBs to hold from 3% to 1%. That's going to free up balance sheet capacity, et cetera. So all of these things together, you put them into the picture, you look at the mosaic and you zoom out. What do you see in U.S. Treasury rates? Well, what I see when I look at this chart is, hey, there's room here for support to step in and bid U.S. Treasury bonds. The other thing we know, this is the 10-year chart, the Treasury for the immediate short term is going to focus on using bills, so the front end, to finance itself. That's where you see the other developments over the last 3 to 4 weeks. The Fed is going to, it has exited from its QT from roughly halfway into 2022, June 2022 to December 2025. So over 3 years, almost 3.5 years of,
Yeah.
quantitative tightening, balance sheet runoff. That's going to reverse itself, but it's going to be implemented. That balance sheet expansion is going to start on treasury bills financing. So bringing short-term rates in. That's quickly becoming the lowest yielding debt on the entire treasury yield curve. What's that going to do? We've talked about this as well. As those purchases start to come in, that's going to start to normalize the yield curve, and we should now enter a period where we're seeing positive slope throughout. And what that looks like for the financial sector is a positive backdrop for credit origination and balance sheet expansion. So what does that mean? Monetary creation into the real economy, where households, businesses, the private sector increases or takes on debt and equivalently increases money supply. So that's something to continue to watch. What are some of the things you look for a green light to allow that to happen? Well, number one is, hey, you don't want to see price levels rising. If there's inflation, that means, hey, we need to dial it back. Don't do this. Slow it down. We just got today, this morning, the inflation numbers showing a CPI year-over-year increase of 2.7%, which was below forecast for all. I think there were 68 forecasters on Bloomberg who put a number on today's print. This was below all of them, so everybody was directionally off, which is surprising, right? Everybody here, each one of those people is probably making well above six figures to put that number out. They have teams, data, et cetera, behind it, and everybody whiffed, which is I don't know what you take away from that. What's the use?
It's kind of like
Honestly,
everybody's always wrong, but the question is how wrong are you?
yeah, exactly. So they're all precisely wrong
Right.
as a group. But yeah, what that shows, 2.7, we missed. I mean, it's not two, but what we found out at Jackson Hole, Fed said, hey, we're gonna stop focusing on that inflation target so much. Yeah, we're still doing it, but we're doing away with that average inflation targeting whole regime we told you about in 2020. We're going to focus on labor now. So what does that mean? Well, biases towards supporting labor markets and economic growth. And if that means easing while creating some inflation, so be it. We'll balance out the trade-offs. But what you saw with today's print says, let's go. All right. So
Right.
you're looking at sovereign debt. There's room to run here. We'll get into the other sovereign markets, but let's say European rates want to go up, Japanese rates want to go up. That'll also, that pull, that gravity into those other sovereign markets. It also works its way through in the U.S. So the pressure, like they all want to kind of the rising tide lifts all boats type of thing. U.S. you would expect to correlate to some degree with global capital flows and the prevailing liquidity conditions. But U.S. has a lot more, I would say, extra space to defend its sovereign debt markets than what we're looking at from others. So I'll quickly get in. Where do we see the epicenter of risk right now? I think most people, just if you survey the man on the street, they'd probably say the U.S., right? Just because it's so much talked about. The U.S. dollar is the largest liquidity pool, all of that. We know the fiscal situation, everything going on. It's all doom and gloom when it comes to the U.S. Debt situation. If you're looking at others, especially in particular the Northern European sovereigns, I think it looks even more considerably, I'd say problematic, might be the best word to describe it. So looking at this chart, same situation, same 3-year look back window. This is the OATs out of France. France. Looking at the support line on yields going back to March of 2025, I think if there's something clear here, remember when we set that support line on the US, it was two data points, Q3 2023 and January 2025. France, it's still running. They're still yields are still working their way up and to the right. You're seeing, a test of that resistance line. I mean, just counting them here, one, two, three, four, five times, four times this year. From a technical standpoint, I think what this is saying is you're looking at a market that, the backstop is continuously having to come in on, a very, actually on an increasing cadence. Q1 we saw that test one time. Q3 we saw that line tested twice. Q4 we've seen it tested twice, and we've still got 2 weeks to go. This is, from a portfolio manager context. If you're looking at this chart, you'd say this looks like a yield curve that wants to actually break out and move higher. So if you're focusing on a sovereign debt market where you're always graded on a relative basis, right? You're playing with international capital flows, FX, how do you fund your deficits, et cetera. This actually looks much more problematic if the worry is rising yields on the long term or pressure on your sovereign debt markets. This is much more concerning, in my opinion, of a chart than what we saw in the US. Now you juxtapose that where I'd say the next most popular opinion, if you're looking at sovereign debt commentary, if it's not the United States, that's the focus of the doom and gloom. Your next best hit is going to be Japan, right? There's no shortage of people saying, "Hey, Japan's going to fit like 250% debt to GDP, or public debt to GDP, all of that." And yes, it is definitely true. But if you're looking at you're doing the same charting, you're looking at 10-year yields. If you're looking in Japan now at a market where monetary policy is moving, basically they're the antipode of US monetary policy since 2022, right? Ever since everybody in COVID, everybody's kind of sine curves, if you will, all synced up. Everybody was cutting to ZERP all at once. Maybe the peak of financial integration that we see in our lifetimes in terms of everybody doing the same thing all at once, maximum centralization, all of that. In 2022, when the Fed started letting its short-term interest rates rise to accommodate a bond market that wanted to sell off higher yields to ultimately fight that inflationary impulse that was showing up in the post-COVID froth, really working its way through the real economy. Japan held its rates low, right? Longer than anybody. EU, UK, they kind of synced up. Western Europe synced up with the United States, but Japan kept rates low. They let inflation run hot a little longer. And the net result of that means we've now got, if you're looking at the amplitude of those waves, the sines, the cosines, what have you, I'm plotting this out loosely here. But if the US is at, one end right now, we're letting rates come in. Japan now, as a trading partner, a key ally, I think if you're reading the tea leaves, you see it in that, Trump state visit that was in October that we talked about on an episode. Japan is on the flip side of that. They're now raising while US is declining. So there's kind of a natural balancing there in not just money markets, sovereign debt markets, but also trade, right? We'll see if this plays out through the dollar yen in the future. But I think the big final thought here, as everybody's worried about Japan, et cetera. I don't know that it's not necessarily or I don't know that it's necessarily doom and gloom, right? That everybody's okay, saying, hey, the BOJ is going to fail, all this stuff. I think it's the fact that Japanese sovereign debt, or the yield curve, is being allowed to rise, is a sign, not that they're doing it because they have to, but because they're enabled, or because they can. Like, they're in a new state where they're over that 40-year deflation that's coming out of that long-term balance sheet recession that's been widely talked about for the last 30, 40 years, right? Um, if you look at the Nikkei, the stocks, Japanese stocks trending up. They're doing it on the back of a weakening yen. But then also you look at it, if you're like, all right, if the yen was failing, right, what are some other data points you would want to look at? And I didn't put this chart in here, but go look at the topics, TOPIX, Japanese financials and banks index. Like, their banks love this rising yield curve. Even if you adjust from, like, for the FX currency effects, from the yen into dollar, which is also, it should be weakening. Even in dollar terms, the Japanese financials are broadly, ripping. They love that interest rates have finally been able to normalize. So I won't say too much else there. The yen carry trade does look like it's not long for this world. Some people will be harmed, but then the next question you got to ask is, who was doing all of that financing, utilizing the negative short-term rates, or I forget how far out the negative rates got, like, trickled into the Japanese yield curve. I can't remember if it got all the way out to, like, the 10-year. It went pretty far in terms of where the negative rates got pulled out to on the yield curve. That era, it looks to be said and done. So some people, some funds, et cetera, the ones who were engaged in the yen carry trade to get that low carry, negative carry to finance their own balance sheet problems. Those will come to roost here as this continues to play out. But I'll say this: I don't think it's the United States. U.S. pensions, insurance companies, banks, hedge funds, they weren't the ones who needed that yen carry trade to finance their own balance sheets. Open question on who have my own thoughts on this, but we'll let that play out and um, yeah,
See where it goes.
see where the bodies arise to the water's surface. I'll say this: it's probably a lot of offshore hedge funds. Look for headlines. I'd say as the um, BOJ continues to allow rates to rise, we're going to see a BOJ meeting here. We're recording this about noon West Coast time on Thursday, December 18th. In about 6 hours, we'll get the policy decision where, just broad consensus is another rate hike is coming. We'll see short-term money market rates in Japan up to 75 bips, 10 years, almost 2%. Japan has the internal consensus to allow its bond market to sell off. They're going to allow rates to rise. And this is, I think, this is kind of the forcing function in global debt markets, that everybody, across the sovereign debt space, across FX, and then trickle into risk assets as well. Basically, Japan is the forcing function at this point that everybody is going to have to answer to. So quickly look at where things are in monetary policy, right? Front end of the yield curve, the money markets, where central bank policy is most effective. Just quick overview of these players to tell you where the boundary, or who is under constraints, right? If this is a capital war, right, the ability to conduct monetary policy actions and basically just let off pressure inside of your currency, inside of your financial system, fight inflation, what have you. The ability to do that or to hike rates or cut rates is a kind of a key element. Like it basically means as a sovereign, as a nation state, your central bank is armed with weapons to fight the war. Now, if you have no control over these things, if the market is telling you, hey, you don't have the ability to change in short-term interest rates, means you have no ammo to go out and fight, right? So if you're trying to weigh, players at the table in this great game, um, having more optionality is a better thing for just fighting this capital war. So start with the Bank of Japan. I think they're the ones who have the possession arrow pointed at them in terms of who is next to move in monetary policy. You look at the BOJ, you look at what overnight index swaps, these are swaps agreements between large scale financial institutions where they will trade basically a variable or floating rate of what the overnight borrowing rate in the future comes in as over a certain term as those rates get set every day on an overnight basis. And in exchange, there will be a fixed leg, just a fixed payment that the other side, the other counterparty in that swap agreement will pay. Those OIS markets are suggesting, just based on that market activity, that those financial institutions are saying they expect the BOJ has the policy space, if you will, or they're they're hedging for the outcomes in that policy space for the BOJ to hike rates another two times or 25 basis point increments between tonight's meeting and let's say next Q3, right? This doesn't say for sure that forecast right now is, a rise from 75 bips to 1%. What it's saying is directionally that move is up. Like they're saying Japan or BOJ, go ahead, hike rates. And then that's translating, if you look at the market signals you're seeing on the longer term debt, the 10-year, and if you go out to the 30-year, I think Japan issues like a 40-year bond. They issue longer than the US market. Um, like all of those signals are saying, hey, Japan, they're going to let rates rise. What does that look like in practice? Well, this is what the US allowed itself to go through in 2022. So now it's 2026 is really Japan's turn in the barrel. It's been a much more kind of elongated or spread out hiking cycle or bond sell off than what the US had to do, gun to its head. The inflation approaching, 9% at the top of that impulse. You had a uh, transition from the Europe versus Russia, long-term conflict, if you will, or developing conflict, turn into a kinetic engagement with the Ukraine, Russia situation in February 2022. Japan hasn't been under that type of same pressure, at least to this point. So its bond market sell-off has been, on a relative basis, much more orderly. So they haven't the financial system, all of that, the markets, they haven't quite had to deal with that same amount of volatility that the U.S. experienced in 2022 and 2023. That's the situation in Japan. Now, if you look at next, I have the United States. Their markets are saying they're going to allow the United States to cut interest rates more, right? So ignore everything you're seeing in the headlines, White House influence over Fed independence, Hassett, War, Schwaller, all this stuff. The markets, like where the rubber actually meets the road, and these players are, making informed decisions with their capital at risk. What they're telling you is we see or we are hedging against roughly 2.5 more cuts. So 50 bips, call it somewhere between 50 and 75 bips lower on the front end in domestic US dollar money markets or overnight funding markets. So That tells you, all else equal, what's the pressure. On the front end, it means lower rates with a US Treasury that's going to begin rolling over and financing itself, at least for this period, call it the next 12 months, or, what we have looking less fuzzy in our crystal ball. If we go out further, it's harder to see, but we see lower rates on the front end and more of our funding mix coming on the front end, which are going to be lower rates, which means, if you're looking at the interest expense on the United States debt, that chart should be going down, and then or expected to go down. And then if you're looking at, say, the federal deficit, all of that, we saw the headlines coming in for, I can't remember if it was October or November, but this administration's policies are actually starting to put a lid on those deficit spending amounts. A lot of it is coming from those incremental tariffs. Um, there's a lot of TBDs. There's a big Supreme Court case that could really throw a wrench into all of these gears. But all of these factors, all put together, they're all contributing to the big picture notion that for the U.S. yield curve, or treasury yield curve, you're looking at a front end that continues to want to move down. And then while the long term, 1 year look back trend looks down and to the right? Yields showing lower lows, lower highs. Um, Even if there is a squeeze in global capital markets, funding markets, really on the back of what's going on in the Japanese yen or the JGBs, combined with the Eurozone, Bunds, OATs, etc. Um, you're looking at a US market with funding conditions where everything, you put the whole picture together. Front end of the yield curve wants to come down, long term wants to come up. Today's inflation print, whatever your thoughts on those, all that matter is all that really matters is policy, central bankers, et cetera, see that they see the green light for expansion of credit in the domestic United States, which suggests not doom and gloom. We'll put it that way for the at least the early parts of the 2026 outlook. So I'll leave it there, Cameron, and then oh wait, we didn't talk about
We have
Eurozone,
EU
right?
as well. Yep.
One more stop on the bus, and then we'll get into the fun story that we just found out this morning. All right, last stop, EU. You look what its own overnight interest rate swaps market is suggesting. You see this curve on the bottom. These numbers look large in absolute times because they're so zoomed in. Look at that y-axis on the right side. It's number of cuts. It's like 0.15 of a 25 bip cut. That, like, these things are measuring like 2, 3, 4, like tiny amounts of basis points on both ends. The magnitude here is essentially nothing. What these markets are suggesting is the ECB, Christine Lagarde, um, they don't have a policy lever in terms of cutting rates further to stem the economic growth that they need, the credit expansion they need. As Western Europe is still coupled up to the United States. I talked about disinflation on the US CPI, to kick your banking system out of that, to get the nominal GDP growth, all of that to turn the corner, swing up. You need to generate a reflation in your financial system, balance sheet expansion. Um, EU is basically, it's handcuffed. It's got its arms behind its back. You can't cut rates further. It's at a precarious crossroads. Like all of these stories, you put them together. How are they going to do this? And I think in my spidey sense here, you're reading the headlines, reading these things about like new monetary implementations, the digital euro, all of that. That's their answer to solve their problems because they've been handcuffed on, the traditional monetary front. Every time you see one of these big transitions, just read the history books. I'd be hard pressed to find a case where, let's say, when the individual like sovereign states that organized and combined in the EU, um, exchanged their legacy currencies, German mark, French franc, Italian lira, all of that into the euro. The private sector took a hit, right? They lost purchasing power. You tend to give up purchasing power when these currency transitions take place. I think that's what we're looking at with this kind of branding that this whole development that really Bitcoin is spearing on in terms of innovation and finance, money and credit. I think the EU is looking to that tailwind going on, and in my opinion, it's really Bitcoin leading the way. But you'll find plenty of other people argue, hey, it's stable coins, it's blockchain, not Bitcoin, it's all these other cool rails that we can now do, whatever. EU can take that wrapper now and do this monetary transition, ultimately pull in, or maybe another word for that is confiscate private wealth that's held in its currency, held in the bond market, all of that, and basically like rebase that to remonetize or get its own financial system back to solvency on the backs of the private sector's savings. It's a classic trick. It's been done like clockwork throughout history. This time is not different, other than the fact that we have a new technology, open source cryptography, blockchain, etc., to wrap it under. So that's what I have right now. So I think, key things to watch. I know we're going to focus on the dollar, treasury rates, bond market, et cetera. From a US investor's perspective, it's really rest of world. I'd say Japan, watch that trend. But it's really the downstream impact, in my opinion, is going to be watch all things lead to Brussels. So watch the euro and how things develop in Northern Europe, and that'll be your signal for how to position for 2026. All right, let's get to the fun story, Cameron.
Yeah.
Trump nuclear.
Yeah, so I'll kind of go into some quick summary here. So earlier today, we got a headline from Trump Media and Technology Group that they will merge with TAE Technologies. For those of you who do not know, Trump Media is kind of the overall company that's behind Truth Social. They also have some other, I believe they have an ETF. They've got some other financial products, etc. And then TAE Technologies has been focusing on building out fusion power. So a couple of different buzzwords that you're seeing there, but this is an all-stack transaction. It's in the headline there, valued at more than $6 billion. I believe the end goal here is stockholders, shareholders of Trump Media and of TAE Technologies end up with about a 50-50 share of the equivalent joint merged company. So really when you start to see some of this stuff, my first thought is, what is going on? Why does Trump Media Group think that they have some type of a alpha generation or some better idea on how to create fusion than other companies? But I think Matt, you threw it out there. They probably don't. um, but I'm gonna flip over to
Almost certainly don't. Yeah, yeah. There's no nuclear degrees. You look at if everybody remembers from the first Trump administration, one of the key talking heads on your cable news channel, Devin Nunes, was in the House. He's now become involved. He's going to be co-CEO of this. So just looking up his background, his undergrad degree, his bachelor's degree, his family history, they're in agriculture and farming. They're not at all proficient in a cutting edge technology like nuclear fusion, which for the last 50, 60 years, we've always been 10 years away from being 10 years away, it seems. So, yeah, it's always right around the corner, one of these things. To think about, all right, where does this asset belong? So, what is this TAE things for background? Cameron, you're about to get into it, but this is like call it like a research funded. Like it started out as venture, right? Venture capital flowing into the industry. Google had a investment here from its venture arm, or Alphabet, Chevron. There's some other notable names behind this. They've put 1.3 billion into this startup project, which I'll get into this, but it still is like not even close to commercial viability at this point. Timelines, I just through my own AI search, Q&A, all of that, um, suggests maybe 2030 to 2035. So we're talking 5 to 10 years away, kind of still jibing. This thing is always just right around the corner, but not really. The announcement today, the articles, the messaging, all of that, they're saying, oh no, this is 2026. We're going to develop the first commercial facility, all of that. Start to think, what in the world is going on here, right? If this is really like cutting edge, you know, advancement in energy production, all of that, as fusion is supposed to be, right? Or has like held the branding as for multiple decades now. Why is this thing not going into the hands of, say, like your existing proficient companies in nuclear energy, like GE Vernova, Hitachi,
Yeah.
all of those, the Emerson, et cetera. Like, why are they not the ones deploying in here? Why is it Trump Media's social media company is basically a hollow shell, um, buying up this energy asset, marketing a massively rosy timeline to like essentially what this amounts to is retail investors who buy like this meme stock is really what it is. Um, so this is just my interpretation of what's going on. I tend to try to read these things with a much more zoomed out historical perspective on how these situations go, um, just based on incentives and how operators have acted in other eras. There's nothing new under the sun. As always, there's just different players, different stories, different timelines, slightly different technologies. But just zooming out, what is this thing, TAE? If you go in and look at their site today, it's down. It's a WordPress site. It's, I mean, you look at this, this looks like a very high-end research project. This, image they have, you know, really to me reminds me of the things you're seeing over summer 2025. Some of these stories with quantum stocks just rallying despite having no viable commercial technology in place yet. I think this is very simple. Like what you're looking at here is not a viable commercial fusion nuclear reactor by any means, and I think it's obvious just looking at this. If you look down, you saw collaborators. It's very focused. You see California Irvine, UCLA, ITER, like just advanced research projects. Notably, what you're not seeing anywhere here is any industry player in the nuclear space. You got Chevron involved, they're oil and gas, right? So you do have some participation, but you got Google funding this, et cetera. So that raises a huge question mark. Why are they not putting capital in? Don't want to compare this, but just right now, this thought clicked in my mind. Remember the Theranos situation. Um, you saw all kinds of deployment into Theranos, the now infamous blood testing diagnostic that was promising to be a test for everything, raise capital from, the Pentagon. I think some of the drugstore chains. I forget if it was uh, which pharmacies it was, but like Safeway, CVS, et cetera. I don't remember the exact investor base. They deployed capital into the Theranos project, but notably there were no other diagnostics, industry players or healthcare, venture funds throwing money into this project. Feels to me like this also raises to those same red flags. Like where's GE on this? Where's Hitachi, et cetera. That is, something I would want to see here if I'm an investor. So you see it in the stock price today. It rallied like the Trump media meme coin or meme stock rallied 40%. What's actually going on here, my opinion, is, with this deal announcement, the insiders are really generating exit liquidity primarily from the retail investor base, who by definition are viewing this project in terms of, um, maybe more rose-colored glasses, if you will. But I think the actual way to describe it is the less informed, right? They're not financial industry analysts who cover this sector, all of that, buying this stock. Um, it's really just fast money retail accounts looking for a pump. And I think, yeah, you get what you get. You'll get what you're going after. I guess we'll just put it that way. But just from background research, I've said this before, technical readiness, TAE has not yet demonstrated net energy gain. What does this mean? You get more energy out of your, test reactor than you're putting in. To make this commercial viable at the bare minimum, like, you have to get energy flowing out of the reactor more than just going in. Otherwise, you're destroying value in the first place. There's also temperature requirements that are probably well beyond current capabilities to produce. I think I saw like something like 25x, maybe 50x. I'm not going to go deep into the technical details here. The point is, like, in terms of timeline reality, it seems to me, just based on the most cursory of research this morning following this headline, the actual timeline to deliver is probably much longer than even the rosy projections on the project chart that are being communicated and being bid today and reflected in that stock price. Um, the other thing is capital requirements. Part of the deal, it is a 50-50 M&A, if you will. But the amount of capital raised to build this commercial facility is $300 million, which I don't know, Cameron, about you, but 10, 20 years ago, that might have sounded like a decent chunk of money. I can just tell you right now, that's a drop in the bucket of what it would take to build, like, just to pour concrete, get the infrastructure, yeah, put the transformers down, build some
That's
special
less than putting
hardware, all
nets
of
underneath
that. Like,
the Golden Gate Bridge in San Francisco.
like in FW, this thing gets done. This commercial reactor gets built for 300 million. Just like, doesn't even. I don't think that number has any bearing in reality, especially in this inflationary environment. Um, what's actually happening here? um, this may be too cynical of me to go this far, but I think when you're dealing with this type of situation, uh, caution is always the best approach. Anybody investing into the DJT meme stock at this point, uh, you're an adult, you know what you're doing, you can make your own financial decisions. But the way I view this, right, this to me looks like a liquidity scheme, and I like to put this in context. There's been a lot of these same schemes done throughout history. Everybody does them. There's nothing new under the sun, but a hallmark, one of these is the South Sea Company. So as a parallel, there's a lot of things that rhyme with the things we're going through in our times, like the situation where the sovereign purse faces pressure, faces a funding squeeze. Um, you have a credit system that tries to accommodate it by fueling a bubble, largely on the back of the latest technology innovations of the day. It's the way this always tends to go, right? So South Sea Company, this was right about 1720. It was a funding scheme. Essentially, the company purchased British or UK sovereign debt, British national debt at a discount, and then issued shares against that debt. And eventually, they really just, through the same sort of headline generation, generated public appearance or public interest and the appearance of value on the stock chart and the run up to generate a kind of speculative frenzy, right? So notably, we go over this all the time. Isaac Newton lost his shirt on this. Even the Chancellor of the Exchequer, who you think would be an insider, right? Like got rinsed in this scheme. So as you're playing with fire in today's modern times, a lot of us only learn through the hard way, touching the hot stove. If we can save one person here, think about these things a little bit more diligently with their hard-earned capital, hopefully the better off. So the scheme will look like it's succeeding temporarily. Because it is at its heart solving a government financing problem, right? You're funding the government debt, et cetera. It's not quite in this case with TAE and DJT Media. It's not buying the debt directly, but it's playing on that same layer of a financialized monetary, framework where to just continuously generate the balance sheet expansion that it takes to purchase that government debt and keep the whole thing inflating. You got to build bubbles on top of the bubble, if you will. And I think that's what you're looking at here. So over the course of 20, 25 years, we've seen, over $1 billion of capital investment into this fusion technology. Like this goes back to 1998, right? Everybody putting money in. It's never paid off or viably, right? It's always right around the corner, but uh-huh. Um, so rather than government debt, like in this case, that underlying asset is that speculative fusion technology that someone's got their cost basis like measured against that. Their capital is tied up in that illiquid project, which hasn't been able to achieve commercial exit in 20, 25 years. Is it going to next year? That's the promise, right? Is it likely to? That's what's up for debate. Um, but effectively, what this deal does is it creates an immediate paper valuation for those TAE shareholders at effectively, this says $53.89 per share, which is, I think it's about a 300% markup over its most recent funding rounds in 2022. So what you're looking at here is exit liquidity of an illiquid private instrument onto the retail investing public or public markets. Notably, I'd call out the price discovery is not taking place through, financial statement reporting, rigorous analysis of, say, institutional investors. It's all taking place through Trump media's own volatile stock and just retail investor enthusiasm, tied to just meme stock mania, as we've seen play out on multiple examples now since 2020, 2021. So I'll leave it there, but that's my opinion of what's most likely going on and what to watch for. I'm just gonna, color me shocked in the future when we find out Devin Nunes doesn't know exactly what he's doing as a co-CEO of a cutting edge nuclear fusion development company.
Or
We'll
maybe
just
we'll
say
all be
that. So
pleasantly
if you look at
surprised
this,
with unlimited clean free energy.
yes, that's the hopeful version, right? Things always play out. The trees grow to the sky. But yeah, if you look at the stock, you see a pump here, up 40% roughly overnight. Looks great for short-term holders. If you zoom out though and look at the DJT stock chart, there's a lot of people, hey, Bitcoin's had a bad year, all this stuff, right? This DJT, stock that came out of a SPAC in 2022, really to greenlight the project of the Truth Social social media platform, right? Competing with Facebook, Twitter, Instagram, kind of the legacy, more Silicon Valley controlled social media networks. If we zoom out, remember 2020, 2021, 2022 era, Trump was booted off of all of those social media platforms. So that was the first kind of business angle that they, or just market that this company said it was going after. It struggled, especially as X with Elon Musk really pivoting into uh, or positioning themselves as the kind of the alternate to the broadly VC owned or Silicon Valley dominated social media kind of platform companies. We've seen a fracturing in the social media space, I would say, over the last 2 to 3 years, where most people along the political spectrum are self-selecting into their own, um, just call it reality bubbles. And you've seen over that time the true social kind of business model not working out as intended, just as that market has evolved over the last 2 to 3 years. Now you see a pivot into apparently a social media and nuclear fusion conglomerate. This promises to be, I, let's just say, I don't know what's going to happen in the future, but it won't be boring. We'll
Yeah.
just put it at that.
Well, I think that's a good spot to leave it for the week. So thank you again for everybody, as always, for tuning in. I think that first half where Matt's really deep diving into kind of the global survey of the bonds and capital flows and all of that is going to be one to maybe go back and rewatch that section. Everything going on with this DJT TAE merger, again, we're going to see more headlines, I assume, over the next few weeks related to all of this. But as we head into kind of Christmas next week, hopefully everybody's able to take a little bit of a breather, maybe turn off the headlines for a little bit. Might be a good way to approach this. But as always, go ahead and like and subscribe. We're on YouTube, X. We post on LinkedIn as well. Matt, I'm not sure if we're gonna do a recording next Thursday, since I believe that might be Christmas or Christmas Eve. But we'll figure out what our plan is, and hopefully get a video out next week.